All right, let's just get right into it. If you were a founder looking to raise capital beyond local borders, maybe pulling in funds from Singapore, Dubai, or California, you've probably already realized that it's a completely different ballgame. In this explainer, we're going to decode the incredibly complex maze of rules standing between you and your global capital. And because this subject is pretty dense, we'll follow a simple roadmap. We're going to cover the global shift, meet the regulatory gatekeepers, break down the actual deal mechanics, walk through the step-by-step process, and finally, look at how to avoid the common compliance traps. Okay, starting off with part one, the global shift and the unknowns. You know, what's really fascinating about the startup ecosystem right now is this massive pivot toward foreign capital. Founders don't just want money anymore. They want the larger checks, the faster decision-making, and the international networks that help them scale globally. But before tapping into that capital, almost everyone hits a wall of unknowns. You'll likely find yourself asking three very distinct questions. First, how much foreign ownership is actually allowed in my specific sector? Second, which bank handles the transfer? And third, seriously, how long is this mountain of paperwork going to take? Look, if you don't know the answers before you start, you're already behind. It really all boils down to a crucial mindset shift. You have to treat cross-border funding as a legal structure first and a financial event second. Founders so often confuse raising foreign money with a simple mechanical wire transfer. It is absolutely not. It involves serious ownership rights, intense regulatory approvals, and long-term compliance obligations. You have to build a solid legal foundation before you can even invite the money inside. Raising foreign money is just a completely different beast compared to local funding. Think about it. Domestic deals close relatively fast, with standard local taxes. But cross-border? You are dealing with strict Reserve Bank of India oversight, massive currency risks if the rupee fluctuates between your term sheet and the actual transfer, and some incredibly complex international tax treaties. You really have to maintain an entirely separate compliance mindset, depending on exactly where that check is coming from. Let's move right into part two, navigating the legal framework and meeting the gatekeepers. Get used to this acronym, because you are going to hear it constantly on your fundraising journey. FEMA, the Foreign Exchange Management Act. This is literally the backbone of the entire framework. It dictates exactly how capital enters India, and honestly, just as importantly, how it exits when your investors eventually want their returns. It sets the absolute non-negotiable boundaries for every single foreign fund transfer you will ever do. But, you know, FEMA isn't acting alone out there. Welcome to the regulatory maze. Your transaction sits right at the intersection of the RBI, SEBI, the Ministry of Corporate Affairs, and the Income Tax Department, plus any sector-specific regulators if you're in fields like insurance or telecom. And here's the big takeaway. These agencies don't exactly move at the speed of a tech startup. A delay at any one of them can hold up the entire deal. This is exactly why experienced legal counsel doesn't wait around. They track and file approvals in parallel just to keep your deal breathing. And right at the center of all this action, AD banks, authorized dealer banks. Think of them as your ultimate operational gatekeepers. You literally cannot bypass them. The RBI licenses them to verify all your documentation, check your valuation reports, and ensure you comply with FEMA before a single rupee is released into your working account. If the AD bank isn't happy, your money simply doesn't move. Period. All right, part three, deal structure and sector caps. So your immediate next steps depend entirely on your specific industry. If you're in IT services or e-commerce, the doors are wide open. You can take up to 100% foreign ownership under the automatic route without any prior government approval. But say you're in insurance, you're capped at 74%. In defense, it shifts depending on the percentage, potentially pushing you into the government route, which requires strict pre-clearance. Knowing your exact classification before you even start pitching to an overseas investor is absolutely vital to avoid hitting a dead end. And it's not just about what sector you're in, but how you raise the money. Your choice of instrument changes everything. Equity shares offer full ownership rights, which pushes you closer to those sector caps we just talked about. But look at debt instruments, like external commercial borrowings. They don't shrink your sector caps like equity does, though they do come with strict RBI end-use restrictions. Or consider convertible notes, which cleverly delay tricky valuation discussions and speed up deal closure for early-stage startups. Ultimately, the instrument you pick dictates the compliance you're going to face. So how do we actually execute this? Let's jump into part 4, the step-by-step process. To get this done without losing your mind, you need a strict chronological playbook. First, confirm your sector eligibility. Second, negotiate the valuation and choose the right instrument. Third, get those legal documents drafted, like the share subscription agreement. Fourth, open your 80 bank account early and coordinate with them. Fifth, execute the regulatory filings. And finally, step 6, lock in your ongoing annual compliance. Skipping or improvising any step here almost always stalls the next one. Now I want to aggressively highlight this number for you, 30. You need to file within 30 days. Actually, let me rephrase that. You have exactly 30 days after share allotment to file Form FCGPR with the RBI. It is so common for founders to finally get the money, pop the champagne, and just completely forget this deadline. Missing this 30-day window invites compounding proceedings and severe penalties under FEMA. Get the money, then immediately complete the filing. Which brings us to the final stretch, Part 5, avoiding common compliance traps. Before you even think about signing a term sheet, you have to ask yourself what actually halts foreign capital at the border. Surprisingly, it's almost never a lack of investor interest. It's almost always an administrative oversight on the founder's side. There are classic errors that will unwind an entire investment in a heartbeat. The absolute biggest one, pricing shares below fair value. The RBI strictly mandates that shares issued to foreign investors cannot fall below a valuation determined by an internationally accepted method. Another massive trap is weak documentation. If your KYC is incomplete or you're missing source of funds documentation, your AD bank will freeze your transfer immediately. And it goes without saying, never, ever use informal payment channels just to save time. It flat out breaches FEMA and creates massive legal exposure for you. And you've got to watch out for the silent killers, currency volatility, and hidden taxes. The exchange rate on the day of the actual transfer can be wildly different from the rate you agreed upon in your term sheet. You have to map out every single payment flow and lock in an exchange rate strategy early. And don't forget hidden tax liabilities like withholding tax on dividends or even GST on advisory services connected to the deal. Those are incredibly costly surprises if you leave them unaccounted for. So I'll leave you with this pivotal question to think about. Is your startup truly legally ready to scale globally, or is a compliance trap waiting to freeze your foreign capital? If you treat compliance as a continuous growth lever rather than just a headache, and engage your legal and tax advisors early, way before you sign that term sheet, that global capital can become the ultimate catalyst for your business. Thanks for joining me on this explainer, and we'll catch you next time.